Good morning. It's great to be with you again. As politicians become more and more involved in the underlying economies, it seems that the amount of volatility is increasing exponentially. And it's becoming harder and harder to try and identify the signals with all the noise that's out there. And what's not making it any easier is AI. I mean, I use Perplexity, which is fantastic in terms of sourcing news and giving you references. But the amount of data that's available is it seems to be increasingly inaccurate. And I'm not just talking about data that's generated by AI, but I'm having to fact check data that's coming out of Bloomberg, out of Refinitiv, out of major media outlets. And it's almost like there's this circular reference where once something gets spat out by an AI, anybody jumps onto it and repeats it. So we've got a lot of noise out there. We've got a lot of data, and trying to find the actual truth and signals becoming more and more difficult. And not only that, but having to look through the volatility to make sure that you're making the right investment decisions is becoming harder and harder. To make long-term decisions that are accurate and not being whipsawed around is becoming increasingly difficult. So today, as usual, I'm going to try and get through all that gumph, all that noise, all that data, and just try and show you exactly what we think the underlying signal is, what the truth is, how we are reacting to that, and how we shouldn't be reacting to that. Not only that, but at the end of the presentation, I have 4 great charts on health innovation. Certainly the worst performer over the last year has been the healthcare sector. So there are some interesting charts to see whether it's time to get back into healthcare or not. And then finally, for those of you who are invested in Signia living annuities and you are frustrated by your 40% global cap, I have some great news for you. So please, if you are interested, ask in the Q&A section and I'll tell you all about our 2 new products that we're launching in that space to assist with achieving more offshore. But first, let's look at February in review. So the outstanding performer was certainly China, up 12.4% in rand terms. Phenomenal performance out of China. That was driven by a number of things. There's definitely some momentum following through from January with the DeepSeek R1 model. And in addition, we had some good, not great, but some good numbers out of Alibaba with their third quarter revenue beat expectations. Again, it's not a huge data point, but the market latched onto it. And then we also had some positive political news with Xi Jinping meeting with some of the corporate founders of various companies. Altogether, it drove Chinese tech, which then drove MSCI China. But it's been quite a narrow performance. If you look at broader China, it hasn't rallied as much. But that's not important because what's important for emerging markets is the narrow tech shares within China. And you can see the EM also a positive 1.3% for the month. Elsewhere, what did we have? You can see the very poor performance from FANG and NASDAQ. So our underweight in technology has certainly helped us during the month. Also, our overweight in consumer staples at up 3.3, that worked very nicely during the month. So one of the reasons that tech underperformed is certainly continuing on with the theme that we've been worried about, that is monetization. But crypto and tech are very closely correlated in look at performance. Difficult to understand what's driving what in causality, but definitely correlated. And we had 2 disappointing data items out for crypto this month. And at one point, Bitcoin was 25% below its highs. And smaller crypto items like Solana was down 50% from their highs over 6 weeks. So what was the news? Well, one is the fact that FTX is about to be wound up, and that will lead to potentially some increased selling pressure. But I think more importantly was the largest crypto heist ever. Ocean 17. It's if the movie has to be made of it. So $1.5 billion was stolen, hacked from Bybit, which is the 3rd largest crypto exchange in the world. And that had some people a bit worried. But not to worry, Trump came out and saved the entire crypto industry over the weekend by saying that he is moving forward with the US crypto reserve, and he named a couple of crypto coins that are going to be in that fund, not just Bitcoin, but a much wider spread, including Ethereum and Solana and some others. I must just caution, I mean, I caution Bitcoin all the time and crypto, that Trump has mentioned this a couple of times, but it doesn't mean that it's definitely going to happen. It may happen. We may get a US crypto reserve that starts buying crypto, but it has to be approved by Congress, which is both the Republicans and the Democrats, and it has to be approved by a number of financial regulators as well. So it's not a done deal. And I think it's going to continue to add to volatility, but certainly for now, until it's proven otherwise, it does create a floor in crypto prices. But we remain underweight tech. We remain underweight Europe, and I've got lots of slides on that. And neutral emerging markets, and I'll talk about emerging markets in China as well in detail. So how did that feed through to our funds? Well, obviously the China ETF, Signia Atrix MSCI China feeder ETF. Remember, we did convert that quite recently from the new sectors, economy sectors, to the feeder, up a nice 15%, so beating the benchmark. And that drove emerging markets, was up 5%. And that also drove South African equities, because Tencent drove Naspers and Prosus, which is the biggest two shares when combined in our South African market. So the top 40 is up 3.1%. Transnational also up, not only because of China, but because AB InBev, which Transnational has a 10% stake in, had some better than expected results that helped Transnational, which has had a phenomenal start to the year, up very, very nicely. And then in third place, the Signia Life Berkshire Hathaway portfolio. So it's interesting that it's the only US fund in the top 5 for the month, the rest of all emerging markets. And it was buoyed by, again, some stellar results out of Berkshire Hathaway that just can't seem to do any wrong. There was some very interesting data points that came out of their results. And one was they've sold entirely out of their S&P 500 passive portfolios, their Vanguard ETFs. And this was a big, big data item, and certainly shows that they're not very positive on the US. However, it's important to note that their entire holding was only $40 million. And they've raised their cash holdings to $350 billion. So it's not even a drop in the ocean. But it is a signal, and certainly, markets do listen to the signals. And while Berkshire Hathaway has been focusing on selling Apple and reducing the equities, they have been topping up on Japan. Also on the fringes, but more than anything else, they have been rather defensive, which is probably working well for them this month, with the US struggling as a result of the Magnificent Seven underperforming. And again, that's our consumer staples, which is an entirely US position, is doing very, very nicely. So it depends on where you're invested in the US. It's been very much a tech pullback so far. Talking of tech, if you look at 12 months, the only US fund is the Signia FANG.AI equity fund. Now that fund had a phenomenal February from a news perspective. It won 2 Raging Bull Awards over 3 years and 5 years, and last night it won its first Fund Hub award over 5 years. So that's fantastic news for the fund. Really, performance on this fund is phenomenal. It's the only US fund in the top over 12 months, when just 2 months ago all the funds over 12 months were US. So we're definitely seeing a rotation out of the US, and certainly we'll talk to that more, because we are overweight the US, and that is hurting our position in the short term as a result of all the noise. But if you look at the top performing ones, EM is at number 1, 25%. South African equities just behind, 24.9%. And then China in 4th place ahead of FANG. So some strong bounces out of China and Europe over the last 2 months. Okay, wow. Okay, so as I said, there's a lot of political statements, there's a lot of noise, there's a lot of data, there's a lot of fake news out there, and it's very interesting to see what is going on and what is driving markets. Certainly in the short term, Europe is bouncing strongly, and that's on the fact that Trump is redefining the transatlantic defense alliance. And instead of the world panicking because Trump is ignoring Europe and ignoring Ukraine, markets are saying, well, now Europe has to start spending. to defend themselves, and that spend is going to drive their economies out of the slump that they're in. Now, I think there's a lot of assumptions there that we need to get into. But first, just having a look at the rather dramatic statements that have been going around. Trump told Zelensky, "Make a deal with Russia, or we're out. And if we're out, you'll have to fight it out." So basically, Trump is forcing the Ukraine into a peace deal. Trump has also paused, as of last night, US military aid to Ukraine, which is quite a big step. It's not just Ukraine, it's realizing that it's on its own, but the broader EU, Europe is realizing it's on its own. Trump said, look, we have an ocean in between, they don't. Basically, it's your problem, it's not our problem. And here you've got US Treasury Secretary of Defense, US Secretary of Defense, Peter Hegseth, saying it will require our European allies to step into the arena and take ownership on conventional security on the continent. Basically, it's time for Europe to start carrying their own weight when it comes to Europe. And he's talking about what he thinks and what the US wants to see in a ceasefire deal. So will there be a ceasefire deal? Well, right now, the US is going alone without Europe and without Ukraine, and they're saying the deal will look like this. 1, there'll be no US troops on the ground. 2, Ukraine will not be allowed to join NATO. 3, Russia will keep the territories that it has occupied. And 4th, Europe is going to have to increase its spend with the US. And 5th, Ukraine is going to have to do a minerals deal with the US. So a lot of demands from the US before they agree to a deal. Now, what does that mean? Bloomberg estimates the cost of supporting Ukraine will push EU defense budget to 3.5% of GDP. That's going alone without the US. Now, it's fascinating to see the chart on the right. It's Trump. You can understand why Trump is pushing for Europe to start carrying their own weight. I mean, the green line shows the EU's defense expenditure as a percentage of GDP, the target. So the 2% NATO guideline is the green line. And the blue line is actual what has been done. So going back to 2005, Europe was spending about half of what they were supposed to. Fast forward to 2013, they were spending a quarter of what they were supposed to. Now, fast forward to 2024, and this is an estimate for the other final numbers aren't in, but it looks like they're getting close to the 2% number. So you can understand why Trump is saying, guys, you've got to come to the party when it comes to spending. But they're at 2%. The market's rallying because of the fact that they are going to have to spend nearly double that to defend Ukraine. Now, when it comes to doing that, for some countries, it's easy. Denmark announced its biggest military investment in half a century, with military expenditure rising to 3.2% in the year of 2025. That's a forecast, up from 2.4. Now, it was easy. Danish Prime Minister Frederiksen just said, we're going to spend. And she said, we have one message for the defense chief: buy. Just phenomenally good. Then things get more complicated. The UK said they are going to increase their spend to 3% over the next decade. A lot can happen in a decade. So Keir Starmer coming up with that, and not only underwhelming with amount of spend, but saying that's going to be that spend is going to be funded by cutting overseas development. So it's something from a global perspective to see worldwide aid being used for weapons spend is certainly not a move that anybody really wants to see. But things get even worse when you look at the 2 biggest nations within Europe, France and Germany. Yes, Macron says Europeans should forge ahead without the US, but he's struggling to even maintain a coalition in France. In Germany, Friedrich Merz declared hours after the polls that his coalition narrowly won, that Germany must achieve independence from the US. Yes, wonderful statement. But does he have the political ability to actually make any changes? I mean, some of the headwinds that are facing Germany include the debt brake, which means that Germany can only borrow or take on a deficit of 0.35% of GDP. Basically, they can't borrow at all relative to the GDP. And that's enshrined in German basic law, which effectively is their constitution, and means that Germans have to have a majority to change that. Now, getting a majority when your coalition has 30% is going to be very, very tough. So yes, everyone in Europe says that they realize they need to spend more. Yes, they say that they want to go ahead without the US. They don't like the US holding them hostage. But besides Denmark, which was able to do it overnight, the major powers within Europe are going to struggle to actually make a difference. Not only that, but Europe still has a number of headwinds. We've got tariffs looming as of today, and I'll talk about more tariffs on the next slide. But the tariffs, the EU is still a massive exporter to the US, and it's likely going to be attacked with tariffs that'll slow down growth. Not only that, but Europe is a major exporter, and they are competing with China. So that's also, and China's slowdown means that China's going to be more competitive in exports. So that's also going to be a headwind to Europe. Yes, there are some tailwinds in the EU. They've got low interest rates. And the ceasefire so far has led to, or the potential ceasefire so far has led to slightly lower energy prices. But energy prices are still double what they were before the Russia-Ukraine war started. Now, Polymark says there's a 47% probability of a peace deal by the end of July, and markets are holding on to that. But we believe that it's going to be very difficult to get a sustainable ceasefire and a sustainable deal without the EU and Ukraine being part of that deal. Now, yes, Europe's rushing to try and put together some deal, and France and the UK are on their own, and they're trying to put together a $20 billion deal, but that's, if you look at what's been spent so far, it's about $260 billion on Ukraine. 20 billion is not going to move the needle all that much. So things are certainly being ruffled up in Europe. They are going to have to start spending more. It's understandable looking at this chart that why Trump wants them to spend more, but it's not going to be easy for them to do it, and it's not going to happen quickly. So we think that while all the other headwinds still exist against Europe, that the ceasefire deal is not going to lead to the ceasefire peace dividends that the market is expecting. In fact, it could even lead to a wedge between the US and Europe if the EU and Ukraine decline the deal that Trump is putting in place. So things are definitely, I think, getting worse, not better, or getting a lot more tense at the very least when it comes to US and Europe. And I think markets are getting ahead of themselves and running on noise, not on signal. So the other important thing we need to talk about when it comes to all the political interference in markets and Trump's New World Order and signal on noise is hopefully allowing us to focus a bit more on that signal. And that's the announcement by US Secretary of Treasury, Scott Bessent, who says that he and Trump are focused on the 10-year Treasury yield. Now, it's important to understand, you can't try and work out what Trump's going to do. You can't even try and work out how you could position yourself for what Trump's going to do unless you know how Trump is measuring himself, because that benchmark or that yardstick is very important to understand whether he's being successful or not. In Trump's first term, he was very vocal that his benchmark was the S&P 500. He wanted the stock market to go up. And it did. Now, second term, Trump's looking broader. He doesn't want to look at just the stock market, which obviously leads to some inequality issues. He wants to look at the broader economy, and getting treasury yields down will make borrowing cheaper, which should help the man on the street, should help the economy. Now, that's a fantastic target or a fantastic concept, but the issue is that 10-year treasury yields include two pieces. One is your nominal, it's nominal interest rate. So half of that is inflation, and yes, you want lower inflation, but the other half is real yields, and those fall when growth falls. So you need to be careful exactly how you measure or how you interpret what's happening, because you could see growth falling, leading to the US Treasury falling, which is what we've seen over the last few weeks, and Trump might think that he's achieving his goals when he's not. So let's dive into this plan a little bit more, just to understand what's thinking behind the plan. So it's a 3-3-3 plan, nice and easy to remember, 3 threes. Firstly, reduce the budget deficit from 6% to 3%. Great. That will definitely get treasury yields down. Increase oil production by 3 million barrels a day. That's huge. That's 3 times Iran's daily production, and that will definitely help with inflation. 3, sustain 3% economic growth. Now, here the concept is quite clever. To reduce the budget deficit means less government spending. And the government has definitely been propping up the US economy. So with the last 4 years, budget deficit's been 6, nearly 7%. So get the government to step back. And I think Elon Musk with Doge as part of that, reducing that spend, makes governments more efficient, but then get US corporates to jump in to fill that gap by cutting tax. And that should then promote spend, and it should drive the broader US economy. And it's one of the reasons why we are overweight US mid-caps, because we think that this is a really great plan. Now, the difficulty with the plan is that there are some conflicting parts to it, and that's what always happens with economics. There's no ceteris paribus. You move one thing and something else pops up, and you end up playing whack-a-mole. So the first thing is when it comes to cutting taxes, if you want to cut taxes, or you've got to fund those tax cuts from somewhere, and unfortunately, the way that it's being proposed at the moment, so the House of Representatives have passed a $4.5 trillion tax cut package that which will extend the 2017 Tax Cuts and Jobs Act, but at the same time, it raises the debt ceiling by $4 trillion. So that immediately puts a spanner in the works of your first 3 plan, which is to reduce the budget deficit. So we'll see what happens there. Now, the other issue is tariffs. Tariffs on their own, it's debatable whether they lead to inflation, so I'm not even going to talk about inflation, but tariffs definitely lead to lower growth. Not possibly directly, some of it's indirect because of this lower investment confidence, and some of it is direct. So tariffs. As of today, 4th of March, we've got 25% broad tariffs on Mexico and Canada. Markets fell like a stone last night when Trump announced that they were going to go ahead. But Trump is talking to Congress tonight, so we're waiting on exactly those details. But as of right now, those tariffs are in place. So if you look at the chart on the right, this is quite fascinating. This is from Goldman Sachs. And this shows the impact of tariff increases on the US effective tariff rate. So the first row there in dark green is the 2018 to 2019 effective tariff increase during the last trade war. And that you can see it was nearly 2%. Now let's look at what's been announced so far. 10% on China and 25% steel and aluminium. Likely, we can actually now include the extra 10% on China. And then additional risks, you go down there with 25% on Mexico and 25% on Canada, oil and gas. Those are actually taken place. So this chart is 3 days old, came out on Friday, but this just shows the huge impact of what's happening. Now, markets are definitely in line with this chart. We know what's announced, and we can guess what's likely. But markets are expecting that the broad tariffs, like 25% on Mexico and 20% on Canada, will be rescinded. And certainly they were in 2018. Well, the auto taxes were reduced and rescinded in 2018. So that's what the market's hoping for. If that doesn't happen, we're going to see a lot bigger falls than just last night. So I think the market's waiting for the Trump today and what happens in Congress. But things are looking, everyone is incredibly nervous. We're not saying that people are negative just yet, but everyone's incredibly nervous because these additional tariffs are huge. And they will definitely slow down growth. Now, Trump wants 3% economic growth. Right now, the US, I'll get to the next slide, but the US GDP now has dropped from 3.9% to 2.3%. So already below that 3%. So Trump needs to worry about measuring his impact very closely. Okay, so that's tariffs. Then we have inflation. Now, it's actually quite incredible. So, immigration. So, and these numbers are startling. So, over the last year, 2024, 1.9 million workers were added. 1.9. So there are 2.5 million workers added to the US economy. 1.9 of those were foreigners. Only 600,000 were US born citizens. And that's just incredible. I mean, that's like nearly 3/4 of the number of people that were employed last year were foreigners. Since COVID, 5 million foreigners have been employed by the US. And foreigners now make up 1 in 5 workers in the US. So that's been a huge support to US growth and definitely helped keep US inflation tamed. So if we start to see a slowdown in that, that's definitely going to slow US growth and turn around inflation. But again, Trump is very clever, and I don't think he's going to dramatically slow immigration. I think there'll be some some visual reports, some high data or highly impactful news items that focus on the wall and a few people being deported by airplane and helicopter and submarine, but the actual numbers are probably going to not be as large as he is saying. Otherwise, again, we're going to have this conflict where you're not going to get that sustainable 3% growth and low inflation if you go ahead with that impact on US labor growth. Okay, so that's where we are. We've got Trump's foreign policy impacting Russia, Ukraine, and the EU, and we've got immigration and tariffs and tax cuts, all trying to achieve this 3-3-3 plan. It's a great plan. It's positive for US growth. It's why we are overweight the US, because we think Trump can achieve this. So I think Trump is surrounded by some incredibly clever people. I think this is a great plan, but it's difficult. It's very difficult to achieve what you want when you've got these conflicting moving parts, and it's going to be, we'll have to see what happens. Right now, the market has been pricing in that Trump is not going to achieve this plan. That's why US hasn't been, US mid-caps haven't rallied over the last 4 weeks, and we'll have to see exactly what happens. If the market proves that it's right and Trump is going to fail, well, then we'll need to readjust our views. But we think that Trump's policies will work through and they will support growth, and then that should turn that around. But it's incredibly nerve-wracking. The data changes by the day, and we're going to, as of today, if Trump doesn't rescind things, we will probably have to cut our equity exposure. So, talking about some of these conflicting aims, I mean, certainly Trump knows that the Republicans won the election because of the huge compound impact of inflation over Biden's term as a result of COVID. Now, not necessarily Biden's fault, but it's what happened. And people don't like inflation because it reduces your purchasing power suddenly. Yes, inflation had come down, but relative to 3 years ago, your movie tickets cost double what they used to cost, and your cars cost 50% more than they used to cost. So that's why there was this revolt and a move towards the Republicans. Now, again, it's about balancing these items. Trump's saying interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Now, unfortunately, Trump's actually right about that, but he's right in the wrong way. If tariffs lower growth and growth plummets and the US moves into a recession, well, yes, the Fed can actually cut rates, but that's not what Trump wants. Trump wants growth to remain while inflation falls. And so for that to happen, with growth to be steady, well, then you don't want inflation to come through, which means you need to worry about tariffs, which the market expects will lead to inflation, and that's going to delay the Fed from cutting rates. So again, you can't have one and not the other. It's not, unfortunately, not possible. But Trump can do 6 impossible things before breakfast. So maybe we'll wait and see exactly what happens. Focusing on the US in particular, as I said, we've got some data to look at. And it's important to look at the data and to look through what the politicians are saying and seeing what's happening at the underlying economy. Now, when it comes to where the US economy is sitting, it's still in a sweet spot. In fact, it's probably in a sweeter spot than it was a month ago, because growth, according to the Atlantic Fed GDP now, which is probably your most real-time measure of growth has fallen from 3.9%, which was certainly very hot and inflationary, down to 2.3%, which is more of a Goldilocks. Yes, we're growing. It's softer growth, but it's still strong growth, and it's hopefully not inflationary. So let's hope that it can stay like that. Now, the latest Atlanta Fed numbers out yesterday were actually negative, but the trend is still one that's positive, and we expect it to bounce back shortly. Now, there's definitely a problem with inflation. Michigan survey of consumer expectations, that inflation expectation jumped 4.3%, jumped to 4.3%, and supercore inflation, which is what the Fed focuses on, surged to 0.76%. So inflation is a problem, growth is slowing, but hopefully slow growth will help inflation. Right now, consumers are feeling trapped. Consumers in the US are concerned. They're worried that their purchasing power is being eroded by inflation. So exactly what they voted Biden out for is what they're concerned about now. So again, Trump should listen to this. Trump will see what's happening with inflation expectations, and his advisors should change his policy. But although inflation is under control at the moment, consumers are very worried that tariffs will lead to much higher inflation. So for now, we remain overweight the US because we do think that there are more headwinds in Europe and more headwinds in China than there are in the US. It hasn't worked. Our US exceptionalism story hasn't worked over the last 2 months. So it's something that we are reviewing very closely. But if we change our mind on the back of US tariffs, it's not going to be switching into into Europe and China. It's going to be reducing equity even further and potentially not even buying bonds because of higher inflation, but just moving into cash. So that's our next step, which might even happen today. For now, we remain underweight tech, as I said, overweight US consumer staples, and overweight mid-caps. Now, again, mid-caps haven't worked because the market is convinced Trump's plans are going to fail and that growth is falling in the US. But one of the things that does support mid-caps quite nicely is the chart on the right. Now, value is never a reason to buy anything. You have to look for catalysts, and value is often a value trap. But it is nice when you are on the right side of value for a change. And right now you can see the NASDAQ 100, which is tech. The green dot shows the current PE relative to the history. It's a 20-year history, and it's a 29 times multiple relative to the 20-year median of 20. So nearly the most expensive of all time. Shift all the way to the right, which is the S&P 400, which is mid-caps, and that's sitting on the 20-year median. So it is actually not at all expensive relative to its parts. Now, that's partly because earnings in everything besides the Magnificent Seven haven't been doing that well over the last 2 years. And that's part of the reason why these sectors haven't performed well and they have been a value trap. But we also see a rollover in that in those Magnificent Seven earnings, while there's a recovery in the earnings from mid-caps. So there is some positive momentum coming through, and we'll have to watch it closely. But at the moment it's being overridden by that earnings data is being overridden by the political concerns about tariffs and immigration and everything else that's going on in the world. Okay, so looking at the other major economy in the world, which is China. As I said, Chinese technology stocks surged in February, just continuing the January surge on the back of Alibaba's Q3 revenue beat. And here we've got a picture of Jack Ma, who has resurfaced after being tucked away for many, many years when he was not in favor, well, in Xi Jinping's favor, but now he's back in favor. And we had a meeting of Xi Jinping with Chinese business leaders where he said that they need to show their talent. And this is definitely a tactical shift. I don't think it's a permanent shift, but it's a tactical shift from the Chinese government away from their common prosperity, which is what saw China massively underperform over the last few years, towards backing the private sector. And it was one of the reasons that revenue beat by Alibaba became a larger story. But as I said, still larger in the fact of it was all of Chinese tech, but not Chinese A shares or broader Chinese sectors. So right now, things are getting interesting when it comes to China. If you look at the chart on the right, it's Chinese tech shares have bounced. So if you look at the total return, which is the top panel there in the dotted green, you can see how those Chinese tech shares have had a very nice bounce. Still far below the S&P 500, which is the blue line, in terms of performance, nearly half the performance of US tech stocks. Not only that, but they remain cheap. Look at that massive discount in forward PE. Now, you only have to go back to early 2022, before common prosperity, when the forward PEs of Chinese tech stocks and US tech stocks were the same. now 60% discount. And it's not because of a lack of earnings. It's not that these shares aren't doing well. Look at MSCI Tech forward EPS growth, and it's sitting, it's now higher, just above 25%, whereas US technology earnings are coming down. So fundamentals are looking good for Chinese tech, and they're cheap. But we remain neutral emerging markets, and I'll tell you why. So other tailwinds to China, they should stop being a property, should stop being a detractor from Chinese growth, which then stop being a detractor from EM growth in 2025. And some of the data coming out of China is also very good. We've got very strong aggregate financing in January. It's at 7 trillion, which was above expectations. And we've got some big numbers coming out today. So today is 2 sessions. It's the starting day of the Chinese National People's Congress. So we could have some positive support coming out of that as the government tries to counter tariffs. Now, that's the issue. The issue is that despite some strong fundamentals, and certainly the fundamentals here are looking stronger than European fundamentals, we do have to still worry about the US and China's AI race. So we could have US sanctions, we could have more of Chinese shares, we could have US tariffs that are put in place. There are a number of things that could impact Chinese stocks in particular as this AI race heats up. Now, when we're looking at EM generally, there are also other tailwinds for a broader EM rally. The one is the Asian capital spending boom. So South Korea and Taiwan are benefiting from that in particular. They've seen that the demand for capital goods imports surge 20%, which generally leads to strong EM earnings growth. We've also seen EM inflation fall faster than DM inflation, which is great, and that should allow EM central banks to cut interest rates faster, which means things become cheaper, and the hurdle to invest more is lower, and that also leads to higher earnings growth. But it all comes down to tariffs. Not only US sanctions and blacklistings on Chinese tech stocks, but broader US tariffs on China. And today, we not have a second 10% tariff moving onto China from the US. China retaliated with 15% tariffs on agricultural goods. So that's, we're now already seeing a retaliatory trade war starting between the US and China. And that is likely to become a broader trade war with emerging markets. And that means that EM currencies are going to weaken. We've seen what's happened to the Rand. The Rand was at 1750 before, when Trump won the election. We're now at 1860. And that means that inflation doesn't slow as fast as we want. It means interest rates can't fall as fast as we want. And that means that growth slows down. So yes, things were looking great for emerging markets and things were looking great for China. And we'd like to actually go overweight emerging markets. But this threat of tariffs and the renewed trade wars as of today keeps us neutral emerging markets because there's just too much uncertainty and currencies are working against us for this to be a sustainably solid investment. So neutral for EM for now. Okay, sure. South Africa. Once again, South Africa is in global headlines, and once again, for the wrong reasons, unfortunately. We had a historic moment where our budget was delayed for the first time with coalition teething problems. So it's not just France and Germany and other major economies in the world and countries in the world that are facing these coalition teething problems and headwinds, but in South Africa as well. So here we've got our finance minister saying the Freedom Front Plus is not telling the truth. Those in the DA, they're always having an identity crisis. And this is him talking about the 2% VAT increase that was proposed at the budget. Now, once again, I talk about fact checking. This is not a correct quote. This was straight from a very well-respected news agency, but when I watched the YouTube video, it's actually, they've spliced together 3 different quotes and put it together. So while the overall sentiment hasn't changed, the quote is definitely wrong. And it's just another example of data that I continue to see being put through. I mean, when it comes to what's happening in Europe as well, with the amount of money that's being spent and the implications, there's all sorts of numbers that are being spat out there with without anyone being able to track back where those numbers are coming from. So quite worrying. Anyway, I digress. The point was the budget was delayed over the fight or the lack of agreement about the 2% VAT increase. Now, why is there a 2% VAT increase? Well, it's because the budget had a massive, I mean, it's just startling, a massive increase in spending. Relative to the medium-term budget policy statement, which was only a few months ago, spending over the next 4 years is projected to be 266 billion rand higher. Suddenly, all of a sudden, we need another 266 billion rand over the next 4 years. Now, that certainly was contentious. Why do we need so much money? And why does it need to be funded by tax increases? That is definitely the least evil of the tax increase, and I'll talk a little bit about that. But the issue is, and this is not about South Africa, this is about governments around the world. Doesn't matter what country you're in, doesn't matter what type of government style you have. When it comes to governments are always spending somebody else's money. And it's always easier to spend someone else's money than it is to actually make hard decisions like cut expenditure. And so we'll have to see what comes on out on the 12th of March. Alpine Macro, this is breaking news this morning. They put out a report taking South African equities from overweight through neutral all the way to underweight because of this, the lack of spending cuts that came through in the budget. They said they'll reassess on the 12th of March. And likewise, we will, but we similarly keep our South African equities neutral for the moment, but we underweight South African bonds because of the budget. Now, Nedbank put out quite a strong statement after the pro forma budget. Obviously, this is not the budget that was no budget was passed, but we all saw what was going to be passed, and they said consumers will be punished for government's lack of spending restraint. And even with the 2% VAT increase, debt to GDP was still forecast to increase to a peak of 76% relative to the previous peak of 75%. So there was a huge increase in spending, leading to higher debt and higher tax. And unfortunately, that spend was all majority of that spend was not on infrastructure, but it was on services. The majority of that spend, the 266 billion over the next 4 years, 80 billion was in the current year, and that was for social grants being extended above inflation, for wage negotiations, public sector wage negotiations being above inflation, and it was an extension of the COVID relief grant. So none of those are infrastructure. Those are all services. Basically, we're borrowing money to eat. It's like taking a loan on your home to go to Woolies and buy food. It's not the right kind of debt either. So that's another thing that is worrying. Anyway, in the signals that went out yesterday, there was a great review by Professor Haroon Borat on VAT and why the government chose VAT. Now, I think the bigger issue is that we should be trying to cut spending, or at least not increase spending. But Haroon is spot on in this analysis, which shows that VAT is definitely the lesser of the three evils when it comes to tax increases. So firstly, a World Bank study in 2016 shows that when you include zero-rated goods, and the proposed budget was to actually broaden that basket of goods, that is actually pro-poor. It's actually a progressive tax, not a regressive tax. So it's not just benefiting the wealthy; it benefits everybody. And then that was backed up by a 2018 Davis Tax Committee report, which is the chart on the right, which shows that a 3% VAT increase leads to roughly the same revenue collection as does personal income tax and company income tax. So those are your three lines. VAT on the left, personal income tax in the middle, corporate income tax on the right. But that definitely has the smallest impact on growth. It's negative on growth. You can see there, they're all negative, taxes all negative on growth, but it's the least negative. And the chart on the right, it's the least negative on household net income. Again, negative, but the least negative. So if we have to have an increase, then let's pray that it is a VAT increase. Now, we'll see what happens on 12th of March. Hopefully, there's some sort of compromise, and we only have a 1% increase of VAT instead of 2%, and that's met with some sort of expenditure cuts in potentially less sensitive areas. This is what we'd hope. It's unlikely there's going to be additional debt because our finance minister is very, very focused on not avoiding the debt consolidation path. because the more debt you have relative to GDP, the worse your credit rating, the more expensive your debt, the higher your cost of debt servicing, and you then end up in a downward spiral, which possibly we already are in. But Professor Haroon points out very validly what we need to do. The best thing we need to do is more reforms. The 2024 Auditor General's report found that there was 30 billion rand in wasteful expenditure in 2024. Now that immediately 30 billion is more than a 1% VAT increase. So without even having to blink and having to have any difficult negotiations with anybody, you can avoid 1% of the 2% VAT increase by removing wasteful expenditure. And that was one of the reasons that Alpine Macro downgraded SA equities, lack of reforms, lack of spending cuts, lack of reducing wasteful expenditure. Basically, they went overweight when the GNU was formed, but since then, we haven't actually seen any significant structural changes come through. Now, things take time, so I think it's a bit unfair to get overly harsh. Things move very slowly when it comes to moving a country, and so it doesn't mean that things are negative, but the world is watching this budget very closely. It's not something that's just going to be be pushed under the rug. And not only that, but the world is already watching South Africa because of the tension between the US and South Africa. Now, the last thing we need, yes, the actual funding that we get, global aid we get from the US is not huge in terms of our GDP, but it is substantial. And already we're seeing job losses happen because of that end of that aid. So, and it also leads to negative sentiment and puts us in the lineup for the wrong reason. And South Africa needs positive investment. We need positive foreign investment sentiment. And this war that we're having between with Trump, and I'm not even going to get into the details, but the fact that we're in a war is negative for investment sentiment, and the budget coalition arguments also negative for investor sentiment. So hopefully we see some tough decisions on the 12th of March, and those tough decisions will then reflect positively by foreign investors, and then we might see some foreign investment flow into South Africa. But tough decisions are tough for a reason and difficult to happen. So we'll be watching close. Okay, let's look at our outlook. So broadly speaking, the data, looking through the tariff noise and all the political warmongering in Europe, the data that's coming out is aligned with our view of a strong US, which is slowing, higher for longer, sticky inflation, but again, cooling, but it's taking its time, but cooling, which supports our view of being underweight global bonds and overweight US equities. We should see continued pressure on interest rates. They will fall, but slowly, as a result of increased fiscal spend, as there's higher defense spending in Europe, but it's going to take much longer than the market expects because there's coalition governments. The UK, which isn't even a coalition government, takes 10 years to do a small increase in their spend. So providing Trump doesn't implement severe tariffs, the choppy risk-on, risk-off backdrop should persist. So that's our background. Now we did reduce our overweight equities in early February. So on the 4th of February, we reduced our overweight equity position from a large overweight to a very small overweight equities. We may take that to an underweight as soon as today, depending on what happens with the Trump tariffs. We remain underweight Europe because, as I said, there are headwinds, big headwinds. They're likely to see tariffs. They are uncompetitive against China when it comes to competing for exports. This peace dividend is going to take time, and we could see things escalate with Europe with the US if they decline Trump's peace deal with China. Certainly, things are looking quite heated in that space. We remain underweight South African bonds. We might change that when we get the budget, but for now, while there's a tariff war, it's bad for our currency, and while there's a lack of agreement on a budget, that certainly people are not excited about our bonds. And neutral SA equities for the moment, but we're very edgy about, when we do decrease our global equity, our total equity exposure, it's most likely to come from SA equities, given the fact that we've got all these headwinds, and not least of which is the fact that stage 6 load shedding was back. I mean, that was a big shock to everybody. Probably shouldn't have been a shock because reading some articles, when you look into the data, the open cycle gas turbines were running at maximum capacity for the week before stage 6, so it was just inevitable that it happened. So things aren't as good as we hoped at Eskom. Certainly better than they were, but they're not great. And likewise, Transnet, yes, things are looking better, but only at the margin, and these things are taking time, so we have to have patience. Now, one final word on the outlook. As I said, uncertainty remains high, and we have a small overweight. But the most fascinating thing when looking at the best asset class performance since Trump's victory is actually gold. Now, we don't have any gold in the portfolio, as you know. South African equities have certainly benefited because gold shares have done nicely. So our neutral equities has benefited from that. And gold is fascinating. So Goldman Sachs now have a target of $3,100 an ounce for the end of the year for gold. So those gold bugs, Goldman Sachs is behind you, and they think it's going to continue to be driven by central banks buying. Now, what was fascinating by this Goldman Sachs report is that we all know that central banks increased their buying 3 years ago when the Russia-Ukraine war happened and Russia's dollar assets were frozen. So central banks, like Russia in particular, but also China and other emerging markets, said, "Whoa, we're not going to touch US assets if they can be frozen. So let's buy gold." But gold actually peaked in terms of central bank holdings, and we're talking now number of ounces. Number of ounces held by central banks peaked in 1990, and it fell to a low in 2008. That was the great financial crisis, and it turned then. So since 2008, central banks have been buying gold, and that's been a steady purchase over the last nearly 20 years, 2008 to 2025. So but it's only in the last couple of years that the gold price has really rallied so hard. So it's interesting that yes, central banks have been buying. There's definitely a demand force, but they haven't been accelerating their buying, whereas the gold price has been accelerating. So, I certainly remain a bit cautious about gold. If you compare that to platinum, platinum over the last 20 years is flat. 20 years ago, platinum was $1,000 an ounce. It's now less than $1,000 an ounce. And I know there are reasons for that. There's a move to EVs and away from petrol and diesel vehicles. But it is interesting when you look at gold reserves. So there's about $14 trillion worth of gold on the surface. Half of that is in jewelry, and platinum is also jewelry. 2.2 trillion of that 14 is in industrial use, so it's definitely less than platinum. 2.5 trillion is in ETFs. Sorry, 3.5 trillion is with the ETFs. And then the smallest holding is central banks, which is 2.5 trillion. So anyway, it is interesting to see what's happening in gold. We remain wrong by not having any gold, but at least South African equities are benefiting from the gold price. Okay, before we move on to Q&A, 4 great charts on health care and health innovation. So it has been the worst performing sector over the last year. There are, again, Goldman Sachs is forecasting a stagflation environment in the US. That means that they think that growth is going to be slowing to recessionary levels, or just above, but certainly below trend. And inflation is going to carry on rising. We have we think inflation is going to be slightly lower and growth slightly better, but still, I think stagflation we're not far off from stagflation. Now, what works well in stagflation, well, your best performing sectors are defensives, like healthcare, consumer staples, and utilities. So we've got some top-down macro headwinds to healthcare, and that's why we have seen healthcare recover over the last 2 months. There's been some nice performance. Still, it's struggling over 1 year, but nice performance over the last 2 months. So let's look at some charts. Well, So actually, before I look at charts, some other data points, and again, this is not a massive impact, but Trump is definitely also reducing government spending in the healthcare sector. So the US has cancelled funding for the Global Measles and Rubella Laboratory Network, also known as Gremlin. And that monitors infectious diseases. Not only that, but Trump has slashed funding for the CDC, Center for Disease Control, which is in the US, and fired a lot of people there. And he's also forced or put a halt on any communication that the CDC has with the WHO. So I'm not saying this is a reason to buy healthcare, but certainly there may be some big demand for healthcare if we don't get the prevention we need. Now, prevention is always better than cure, but if you're cancelling your funding for prevention, well, then you may have some problems later down the line. But anyway, that's just an aside. Let's look at these charts. So the first is quite fascinating. This is on the left-hand chart. It shows US healthcare earnings relative to US healthcare sales. Now, sales revenue continue to be incredibly strong during 2024, but earnings have fallen. Now, part of that is due to accounting changes, and that, according to MRB partners, those accounting changes are now in the base, so we should see some recovery in that artificial impact. So even if revenue growth just slows down and stays positive, earnings should accelerate. Okay, positive story one. Positive story two is aging demographics. And the blue line here shows the percentage of total population above 65 years of age in the US and how that's just going to continue to grow. The US is certainly got one of the younger populations compared to Europe and Japan and China, but it's aging very fast. Fertility rates are dropping, and the boomer population cohort is retiring, and that's leading to this massive increase. So that's, and that should lead to the demand for healthcare spend being nearly double US GDP. Now that is reconfirmed with this chart on the right, which shows that this is US personal consumption expenditure on healthcare services. And you can see that year-on-year change, it's close to 10%, relative to pre-COVID at around 5%. So even though COVID has come and gone, and we've got a more normalized base, we're still seeing healthcare service spend nearly double what it was before COVID. So that's good. And then the chart on the left, this is the one that's a bit of a mixed chart. This shows new drug applications. So this is particularly important for pharmaceutical companies. So this is new drug approvals by the FDA. And you can see there that, we've still got some very strong pipeline of drugs coming through. But if you look through this, some of the details aren't as exciting as this headline chart shows. And the reason for that is the large cap shares aren't actually the ones with the biggest pipeline. This pipeline that we're seeing coming through the FDA, most of it is sitting with the smaller cap companies. So if you invested in a broad market cap weighted healthcare portfolio, you're missing out on some of the details. Now, unfortunately, it's not as easy as just buying small cap healthcare stocks, because you've got to know which one to buy, and with high interest rates, things are still quite tough in that small cap sector. That's why we're underweight the small cap sector. If you knew which one was going to be bought out, because that's what's inevitably going to happen. You've got the big healthcare companies sitting there with large amounts of cash on their balance sheet, dwindling pipelines of drugs. They are going to be buying out some of these small caps. So select small caps will do very well when they're bought out, but broader, I don't think, they're not going to buy all of them. So we're still avoiding small cap healthcare sector. So this is the one sort of medium sector, medium or even negative point in terms of healthcare. And one of the reasons that things have been struggling over the last year is this dwindling pipeline. But broadly, although we haven't bought into healthcare yet, we are in our balance funds, we are getting more and more excited about doing so. So not pulling the trigger yet, but getting closer and closer to pulling the trigger on healthcare from both a macro perspective in terms of stagflation, as well as a sector specific in terms of healthcare spend. But we are worried about some of the drug pipeline holding back short-term revenue sales. Okay. Sure, that was a record one. An hour for the presentation. Just because there's so much news coming out. I nearly said so much noise, but it's true. There's so much noise coming out, and to distill all that noise into news is getting more and more difficult. So thanks for bearing with me. Let's look at some of your questions and see what we can answer. Okay. Hardy says, is there a Signia fund that gives exposure to European defense industry? No, there is not. We do have the Stocks 50, Signia Itrix Stocks 50 ETF, which gives you exposure to the biggest companies within Europe. And those are certainly rallying on the back of defense spend. So yeah, they're not rallying as well. So certainly the best performing sectors is certainly defense spend. But you can get a broader European exposure through that Stocks 50 ETF, which didn't make top 5. Well, it did make top 5 during the month, but it fell out because it was pushed out by China. But certainly the Stocks 50 Euro Itrix ETF has been doing very nicely over the last 2 months. Bronwyn, thank you. I'd forgotten. Bronwyn says, please talk about the 2 new products. Okay, so we are launching for Signia living annuity investors only. We're launching 2 new products, the Signia Life MSCI World Plus Fund and the Signia Life Dollar Cash Plus Fund. And Signia living annuity investors will be able to invest in those 2 products and increase their offshore exposure from the current cap of 40% to 80%. So that's a huge increase. So we're hoping to do that at towards the end of March. So please keep your eyes peeled and your ears wide open for more news on that. We will definitely be we're sending communications on that when those are launched. Those are in the pipeline. They've been approved, and we're very excited about it. So it's a Signia Life MSCI World Plus Fund, and it's the Signia Life Dollar Cash Fund. They're not purely passive. They actually, there's a little bit of active involved, which should allow them to outperform those indices slightly. And it takes on a little bit of risk with a small amount of outperformance. And so they're great products, and they will allow living annuity investors in South Africa, in Signia, to go from 40% global to 80% global. So yes, very excited about that. Keep an eye out for that. Louise says, which Signia fund is the largest exposure to military defense stocks? That's Louise, that's a great question. I'll have to look into that. I don't actually know the answer to that. It's not or it might be the Fourth Industrial Revolution Fund, but I don't think so, because the Fourth Industrial Revolution Fund has moved away from small caps to US small caps to US large caps. And certainly US large caps are very much dominated by technology shares, by Magnificent Seven. Even though we are underweight the Magnificent Seven because we've capped that, we try to get a bit more mid-cap exposure in that. It's definitely not focused purely on defense stocks. So let me look into that, and I'll get back to you for the next webinar. Or if someone in my team can just have a quick look to see the sector exposure to defense stocks in the Euro ETF, Euro Itrix ETF, and the 4th hour ETF. Team, and you've got probably 20 minutes. See if we can get those answers back before the end of the webinar. Otherwise, I'll let you know next webinar. But a great question. Whichever it is, it's going to be quite small. We don't have any fund with a large exposure to defense stocks. And ironically, when you look at our ESG fund, weapons are one of the things that ESG stocks avoid. So it's almost anti-ESG, but it is the world we live in right now. Certainly a sector that's performing incredibly well, and definitely there's a lot of debate about whether weapons are actually good for society. When you need to defend yourself against people invading your country, anyway. Definitely a lot more debate about that than before we had the escalation in wars. Okay, a long question from Mr. Nika. US trade deficit is over $800 billion, half of which is due to the trade deficit with Canada, Mexico, and China. On top of that, funding EU's defense, which enables them to run high social programs that the US citizens do not get. And the US consumer is not going to suck up the production of countries blocked named. what happens to the economies of those countries, better to right the current huge imbalance, and it may take short-term pain. Okay, that's a very, very good point. So, the world is in a tough place. I think no one's going to disagree with that. Part of the reason the world is in a tough place is because the world population has doubled over the last 40 years. And so there's a lot more demand on resources and a lot fewer resources relative to what is needed. Now, we've also had, so because of that, we've had growth slowing. We've certainly had per capita GDP slowing quite dramatically. So even though we probably have the most number of people in the world with the highest level of services, per capita GDP is falling globally. People are getting poorer in real terms as you're having to share that and spread that wealth across more and more people. So people are unhappy, and that's why I spoke about before. We've had for the first time ever, every incumbent government lost voting share in 2024. Okay, so we've got a problem with not enough resources to go around. People are unhappy, and we're seeing more nationalism, and we're seeing governments to stay in power are certainly becoming a lot more populist. Okay, so where am I getting to with all of this? The irony is that some people say that what's wrong with the world is that capitalism is just falling apart. And they point to what Musk is doing. Part of that is true, but part of it was also true, and this is what Mr. Nike is saying, is that we haven't had enough capitalism lately. So we used to have things like creative destruction. So when things weren't ghost companies that weren't actually weren't productive, they would just be shut down. Yes, there was employment losses, but that kept people employed, and so you avoided depressions, but you had some recessions, and you kind of just kicked the can down the road. And that is fully understandable. You don't want people to not eat, and you don't want people to not be employed, and so you avoid the hard decisions, and you try and you just kind of muddle along, and that's where we are. We're in this kind of post Great Financial Crisis, post COVID world of a lot of government spend. The governments are getting involved with the higher taxes. It's very much things aren't as efficient as they used to be, not as productive as they used to be. So Trump is saying, listen, enough. Let's try and let's overturn everything. And he's saying what Mr. Nike is saying, let's a hard reset. There's too many social welfare programs. The world, people aren't actually looking after, carrying their own weight. Europe is not, it's nowhere near spending enough on NATO. And let's be tough. Now, being tough is not easy, but it's tough. Cutting spend to global aid programs is a disaster. But I can see what you're saying at the same time, that someone must have to make a hard decision to get a hard reset, to try and reboot the economy, to try and get things working, to get capitalism working again. So sorry, lots of what I'm saying, but capitalism is, the world is in trouble. And part of that is because we now, to fix that, we are breaking capitalism. Trump's trying to fix that by some hard resets, but they're seriously hard resets. They may work, but it's going to lead to some hard decisions, which are very tough. It's going to be unpopular. They may not work. We don't know. This is what I can promise you. Okay. Long story short, we're in for a lot of volatility. Hopefully, productivity improves. Hopefully, growth, low inflation growth comes through all of this, and Trump's 3-3-3 plan, pushes us through. And hopefully, some fiscal spend in China and Europe, particularly Germany, because they can afford it, helps support some of those economies, and we get a rebalancing, a great rebalancing. But you don't get rebalancing without pain, and that's that is the problem. And so yes, that's where we are. Good point. Sorry about the long answer. Okay, I think I answered your next question about the trade surplus. So hopefully that all gets wrapped up in that rebalancing of these huge trade surpluses and trade deficits. Okay, Andre's question. Your home view for a 10-year investment strategy, a balanced approach, skeleton balance 40 and 70, or a general equity approach, S&P 1200 and ITEX industrial revolution, or combination of both? Okay, Andre. So if you are investing on a 10-year investment horizon, on a 10-year investment horizon, you can, if you're not too risk averse, you can actually afford to be 100% in equities. Now, Regulation 28 doesn't allow that. So if you're investing in a retirement fund, you can only have up to 75. So you'll probably be capped at 75. So you probably want a skeleton balance 70 fund. If you're outside of a retirement fund, well, then you can actually afford to have 100% equities over that 10-year view if you're not too risk averse. If you're too risk averse, then maybe stick to a skeleton balance 70. But over 10 years, your equity volatility generally is a lot smaller than over the short term. So that comes down to your risk profile. But I think a skeleton balance 40 is probably too conservative over a 10-year view, unless your view is less than 10 years, unless you actually want that income. If you're living off that income over 10 years, then you want both. So my view is, if you've got a low to medium risk appetite over a 10-year period, skeleton balance 70 is spot on. It's the best for you. Low cost, 35 basis points plus VAT. It's got all our global equity themes. It's got our local and global credit. It's well diversified. It's got our TAA risk budgeting. It's a great fund. You all know I love skeleton balance 70. It's my favorite retirement fund. If you've got some money outside of the retirement industry and you want slightly more risk, so if you've got a high risk profile, then over 10-year view, you can actually afford to add to skeleton balance 70 and have a little bit of either. If you've got medium risk and you want diversified, then S&P 1200. But if you want specific US tech exposure, so you want slightly higher risk, then you can take a fourth industrial revolution fund. So that's as your risk increases, so you can move from skeleton balance 70, 1200, S&P 1200, fourth industrial revolution. Okay. Okay, Mr. Nike is solving the world problems. He has a proposal: no increases for any public sector employee or politician if there isn't a balanced budget. Too much inefficiency has resulted in public sector debt now being over 5 trillion. Sorry, I think he's talking about South Africa. I think our interest on debt now is greater than the total debt was in 1994. So you're spot on. Our interest burden is 20% of our revenue. It is almost unsustainable. We definitely need to get our debt down. Not only does getting our debt down, consolidating our debt works twice, because A, you have less debt, so you're paying less interest, but B, because you have less debt, the cost of the interest comes down. So now you're paying a smaller amount on a small amount. You've got a double benefit. And then all of a sudden, then investors want to buy your debt. So there's almost a triple benefit. So we definitely need to get our debt down. Now, that said, there's no easy solution. We don't want to get stuck like Germany right now we have this debt break where it enshrines the constitution. You can't ever have a budget deficit, because there are times when the government does need to have counter-cyclical spend. There are times when consumers are concerned, consumers are too scared to spend, you're heading for a recession, and the government needs to step in and do some counter-cyclical spend. It is necessary. But again, how do you spend? You should be spending in infrastructure. You shouldn't be spending on services. So it's a whole nother decision about where you spend. Yes, you're again coming up with a very hard solution. Sorry, this all of a sudden has become very political, and I don't like to get into politics, but we've as growth has slowed, the world has been forced to have more growth supported by fiscal spend. Fiscal spend is controlled by governments and politicians. So by definition, politicians and politics is now influencing our market and our economic outlook. And that's why that volatility is increasing. And there is no simple answer. I can promise you that if there was a simple answer, we'd be doing it. But there's no simple answer. And then there's vested interests, and we don't even get into vested interests. So I'll try and talk less about politics. Here's a great question by EJ. He says, I'm interested in Signa ETFs, yet the liquidity is low, therefore the spread is wide. Now, EJ, I must unfortunately contradict you. Well, I'm going to agree with you and say liquidity is low, but I need to contradict you about the spread. Signa's spreads are the lowest in the industry. We're very proud of our spreads. We've got a 0.5% spread on most of our ETFs. And that spread is created by us working incredibly closely with Jane Street. They're our market makers. They're the largest global market maker in the world, and they provide liquidity. So yes, if you're expecting, if you put in a bid and you're expecting someone else to come and lift your bid, or you put in an offer and you're expecting someone else to come meet your offer, there's not much liquidity on that. But if you want to do a trade of any size, it's there. That liquidity that's offered by 50 basis points spread by Jane Street is there. You can't see the whole size because they don't disclose the whole depth. But if you want to trade more, they quickly restock that, and you can carry on trading at those levels. Or if you want to do a trade that's bigger than what you can see on screen, phone Signet Securities, and they will organize directly with Jane Street. They will organize you a block of shares at the best price. So maybe that should be my suggestion, is phone Signet Securities if you're wanting something that looks like it's bigger than on screen. But we have a service level agreement with Jane Street where they have to maintain those very tight spreads, tighter than all the other ETFs in the market, and they will provide the liquidity. They don't show the full amount on screen, but they will top up as soon as you eat into that. Anonymous says this is a good time to buy bonds. Anonymous bonds are looking cheap, but they're cheap for a reason, and it's more likely that they will probably stay at these levels. I'm not expecting much capital gains. We prefer our enhanced income fund, which actually got a higher yield than our bond fund with less volatility. So when you're getting a better return, lower risk, that's our view. Wayne says, spiraling debt to GDP, poor government discipline on expenditure, low growth, and minimal percentage of population responsible for tax collections with masses on grants. Okay, clearly we talk about South Africa. Yes, Wayne, that's spot on. How do we reverse without increasing VAT and taxes even further? Is at a point of no return? Plus, is sovereign debt at risk of default? Okay, lots of questions there, and they're very good questions, Wayne. I've answered some. Next month, Professor Haroon Borat, who's a professor in economics, focusing on South Africa, will be a guest speaker for Q&A, and so I hope you bring some of these questions back. But I think what he would say is that we need to grow our way out of the problem that we're in. If we can grow our way out of our debt, then growth will help employment, and the debt GDP will fall. Now, growth is not going to happen in a vacuum. Growth needs reforms. Growth needs public-private partnerships. Now, we already are seeing public-private partnerships happening with Eskom and to a small extent with Transnet, but that's the future. South Africa is very lucky. They've got a massive, very liquid, and relative to the size of our GDP, large retirement system. And that retirement system is aching. Certainly, we are aching to invest in these infrastructure programs, and the infrastructure programs will not only streamline reforms and help things be more efficient, but they will drive job growth and growth in general. And that's good. So what we need is these infrastructure projects to see the light of day. Again, things are moving slowly. They're definitely moving in the right direction since the GNU formed, but not fast enough. I do think that they will happen, but many talks. As I said, we underweight South African bonds, neutral South African equities. We'll probably go overweight South African equities once we start to see these infrastructure programs see the light of day. We're still waiting for renewable round 5 to take place, and they're busy raising money for round 8. I mean, it's just ridiculous. This for energy. Things aren't happening fast enough, and that's for a lot of reasons. But I don't think there's going to be sovereign debt default. I do think we can grow our way out of this, but we do need reforms, and we do need spending cuts. They've got to be balanced. You've got to be realistic. Things aren't going to happen in a vacuum. So we have to maintain social grants, but if we can cut expenditure in other areas that are less politically sensitive, certainly remove wasteful expenditure, and then get some growth coming through because of these basically privatization of the retirement investments. I think we can get our way through this, but it's not going to happen overnight. Okay. Anonymous says, over the longer term, 20 years, will the US be able to fend off the rise of China? Ray Dalio's recent books leads one to believe that risks are quite high for the US to be looking at a decline as world power in future, just as Netherlands, UK. Anonymous, you spot on. The decline of empires takes a lot more than 20 years. Certainly, US is declining in terms of its percentage of its reserve currency. It still remains the reserve currency of the world, but its percentage share has fallen from 70% down to 60%. So we're seeing a decline, but it's going to take a long time. And the US has still got besides China, has the most, the best private protection, private property laws, still got the most R&D spend. So it's still got basically the most efficient markets. Capitalism works the fastest there. It's definitely, there's some hard issues with people not being caught by the social welfare net in the US. So it's not quite as comfortable as Europe, but it's probably the most efficient, and that will keep US growth going. I think even if the dollar does decline, it's not going to decline rapidly. China, on the other hand, they're spending more than the US in terms of R&D. They've got more patents, but they don't, private property rights are not enshrined, and common prosperity remains the key focus. So I don't think they're going to do as well. But it all depends on that balance where you've got to just the world is in a tough place. We have too many people, and there's not enough resources. And yes, the US wants to take the hard decision, but push through with with take the knocks now and become more productive. But then you're gonna really hurt some people, and it's trying to find that balance, and it's becoming more and more difficult. Anonymous says, do you have an update on Signia OSE fund? Okay, so Anonymous, good question. There was a note that went out about 2 weeks ago, which gave an update on the Signia OSE fund. So please email admin@signia.co.za if you do not receive that note, and you will we can send it to you. Magda still plans to personally hold a webinar on the fund. I'm not sure on the exact dates, but that should happen. So please keep posted on that. Tammy says, do you see pressure on SA business to scrap BE because it is only enriched a select few? Certainly has not done much to empower Black entrepreneurs, or could there be pressure to fundamentally revise BE policy in light of Elon Musk pressure relating to possible introductions of Starlink? And you say, sorry, I'm reading these very fast. Tammy, I think we still have a lot of inequality in South Africa. Yes, BE hasn't worked as it should have. There's been a lot of corruption, but I don't think we're in a position to unwind anything just yet. Hopefully with reforms, we get it working more efficiently. But I think there's been a lot of factually incorrect statements that are being thrown out around there when it comes to what Elon Musk is saying. Certainly, there are some horrific incidences of violence, which is horrible. That's the case, and I'm hoping we can sort out the violence. But I can't see BE being scrapped anytime soon. Hopefully, with reforms, we see everything, all our policies being implemented far more efficiently and far more fairly, and we see a much wider benefit to everything that's happening in South Africa than just a few corrupt people. Rahib says, given DeepSeek's entry into the market, coupled with their cost-effective model, training, and open source approach, do you anticipate the US AI companies will maintain their high valuations in the short to medium term? Rahib, that's a great question. So one of the reasons we are underweight tech is we do think that there will be some challenges to monetization of AI models around the world. So I think that DeepSeek is going to accelerate the speed at which AI happens, and it was already happening at an exponential rate. So as these open source models all get used amongst each other across the world, we're going to see faster and faster and faster development. But it's also going to, certainly China, the fact that China worries more about common prosperity and less about private property rights means that whatever models they come out are going to come out at cost. So that's going to keep a lid on how much US companies can charge. Certainly, some people will say, listen, I don't trust China with my data, so they'll happily pay a premium to US companies, but not everyone. Some will say, listen, Musk is going to steal our data anyway, so let Xi Jinping use our data, and it's for free rather than paying a huge surplus. So I do think that that these open source AI models are going to see an increased use of development, hopefully a better answer. My biggest concern is just the responsibility of the information that's out there. We just, I'm seeing, I'm sure you're seeing it the same, but I'm seeing more and more fake data. It's not called fake data, but incorrect data seeping into what I used to think of as high-class data services. And I think we're in this point where there's so much AI-generated data that it's almost impossible to see the wood for the trees and work out what is the truth. So I think AI is leading to a proliferation of noise, a proliferation of data, but not an increase in knowledge, not an increase in information, and not an increase in signals. So it's actually becoming harder to see the truth than easier, even though there's more and more stuff available. It's quite interesting. I'm sure someone has a fancy term for it somewhere. Catherine says, is there an Sigma ETF which tracks gold and one which perhaps crypto? Unfortunately, Catherine, no, we don't have a gold ETF. So you'll find that if you want a resources ETF, then you need to get an ETN. ETNs tend to track the commodities, and there is some credit risk associated with that. Not much, but you'll need to get an ETN. What you can do is on the Signia Alchemy platform. So if you're a Signia investor, you can buy a gold ETN through our platform. It's not a Signia ETN, but you can access it in that method. Do we have crypto ETNs? No, they're not legally allowed. We are in discussions with the JSE and the SARB and the FSCA, and it looks like FSCA are promising to have a crypto ETN out this year. Now, we want to launch a crypto ETF so that you can buy Bitcoin at the cheapest possible way. That is probably going to take a bit longer because you need to change Cisco regulations to be able to buy a crypto feeder fund. So in the short term, what's going to happen is you're going to see banks being able to launch South African JSE listed crypto ETNs. Once again, you'll be able to buy that ETN through our platform. It won't be a Signia ETN because we don't issue ETNs. It will unfortunately have credit risk and it'll be less efficient, but it will hopefully at least be a foot in toe in the water. So we'll see. That should happen towards the end of this year, which means hopefully by sometime next year we'll be able to launch the Signia crypto ETF, but nothing in the short term. Trevor says, you said that a VAT increase would have the lowest overall negative increase on the economy. Wouldn't the poorest people still bear the brunt of that negativity? Trevor, so that's the logic that you would think. I think what it is that they on an absolute basis, actually, I don't know. What I can point to is the research that Professor Haroon quoted, and that's that it's actually when you include zero rated goods, the tax is actually you tax the rich and the middle class more than you tax the poor, and we certainly are looking at widening that basket of zero rated goods. So according to both those reports, it is widely spread. George says, what is your asset allocation going forward? Should the Trump tariffs realize? So, we're going to be watching Trump's speech to Congress tonight, but I think if there's no certainty on the unwind of the tariffs that have been put in place, we'll probably have to sell some equities and go a bit more defensive. We'll see exactly what happens. Sunil says, is the ITRIX regulatory compliant? So ITRIX ETFs are all global equity funds. So you can only hold offshore. You can only in a Reg 28 fund. You can only have up to 75% equity and up to 45% global. So you'd have to keep your ITRIX holding within those Reg 28 limits, but you can hold up to that limit. So you could hold up to 45% ITRIX at the foreign limit. Rosemary asked about the recording. Rosemary, all our webinars are recorded and they are posted on our Signia YouTube site. So please have a look there. It should be up quite soon. Sorry, Anonymous, just going forward, if you can please just give your name, then I know which questions I have answered, which questions I haven't answered that are coming through. Chanel Cooper says, what is the best Signia ETF to get exposure to US mid-caps? Yeah, there has been some debate internally about whether we should be launching a US mid-cap ETF. For the moment, we aren't. So right now, I suppose it's probably Berkshire Hathaway. It's not an ETF, but our Berkshire Hathaway fund is certainly more diversified than our S&P 500 ETF. But that's, those are 2 points into the portfolio. Probably Berkshire Hathaway is probably the most, then fourth Industrial Revolution, and then the least diversified or the most large cap is S&P 500, and then FANG was the most large cap. Oh, thanks. Thank you, Vessel. Okay, so SIG EU, that's our ITRIX, our EU Stocks 50 ITRIX ETF, has 5% exposure to defense. So that's 5% of the 100% of that EU exposure is defense. Fourth Industrial Revolution has 1% exposure to defense. So if you want to get EU defense spend, that's certainly where we are going to see an escalation in spend. That is our Stocks 50 Europe, our Stocks 50 ETF, 5% defense spend. Signia Fourth Industrial Revolution Fund has 1% defense, and that'll be US defense. And we might actually see a reduction in US defense spend if they end up supporting both the Middle East, or both Israel and Ukraine less than they have in the past. Okay. Bradley says, hi, Kyle. What do you think about the trader who went long on Bitcoin and Ethereum right before Trump crypto reserve news? He used a 50 times leverage to open a $200 million position, profiting around $6.8 million. Wow. Bradley, as you say, that's probably insider trading or someone who's very lucky. We'll never know. But that is, one of the issues with crypto is the fact that it is decentralized, it is more opaque. Those are definitely the benefits, but those benefits mean that you have credit risk and you can get hacked. Also means you can't see who's buying it. Are they criminals? Is it people that are front running? Those are some of the pros and cons of crypto. It doesn't mean crypto is going to go away, but it is the issue. Anonymous says, is it possible to transfer an existing living annuity definitely, you can definitely transfer living annuities from other life companies to Signia. And one final question, diversification is possibly the best tool investors have for sensibly investing and managing risk. I agree with you there, thank you. How does Signia diversify medium to long-term portfolios over the following investment outlook periods for a moderately aggressive investment risk profile? Okay, and then it's the question gives 3 timeframes. One is 3 years, one is 5 years, and 1 year is 8 years. So, assuming your risk is constant, as you've said, moderate risk, it's timeframe really does come down to a life hedging event. We do have a life hedging model, and so if you want to find out more about our life hedging model, have a look at Signia for You, and there we actually tell you exactly when you start moving from a high equity portfolio into a low equity portfolio. But roughly, around 7 years before retirement, you start switching out of high equity portfolios, and you scale down from 7 years down to 2 to 3 years. Then it depends on what you want to do when that money matures. If you're going to put it into a living annuity, then you don't want to be 100% in cash because then you're not matched. So then you probably only want to glide down into probably a skeleton balanced 40. If you want to spend all that money, so it depends on, if that money is for university fees or holiday, well, then you probably want to, you want to, over those 7 years, you want to scale down to something that's enhanced income, generally cash. So it all depends on what you want to, where you want to be at the end of your period. We generally look at that glide path of about 7 years. Okay, it's past 12:30. I've run out of time. Thank you so much, everybody, for all your questions. I really appreciate it. Thank you so much for joining today and every month. And I look forward to seeing you next month with Professor Arun, where we can have some more difficult questions and try and solve the world's problems with a mix of economics and politics. Okay, all the best. Cheers.